Well, you had 2 years in a row, 2012 and 2013, with double digits, high double digit returns. And 2014 has started on a somewhat weaker footing. And this comes against a backdrop in the United States, for instance, of an improving economy. So that shows that a lot of the good news that we're going to see in 2014 was already discounted by the market in 2013. So what you could have is an economy that is slowly picking up, but an equity market that is struggling. So we are looking for relatively low returns this year, still positive as an asset class. We overweight the equities. We're looking for positive return, but in the single digits rather than the double digits as we have seen over the past 2 years. We don't think there will be a hard landing in China. I know we have been talking about this for many years now, always expecting the worst. The fact is that China tries to rebalance its economy away from fixed asset investment and exports towards consumption, and that means lower growth rates. And that's what we're seeing right now. On the other hand, there's a fine line that the authorities are walking between slowing the economy too much and thus causing social unrest possibly or other turmoils and overheating. So I think they have the ability, they have the financial means to keep things together. It's not exactly an ideal situation because the whole boom in China has been based on credit. And at some point, we're going to pay the bill for that, but we don't think that's going to be the case in 2014. So we're not negative on China, but we have to watch out, of course. If there's anything happening, it could actually come out of China. Well, there has been a flight to safety during January. We have seen that reflected in lower treasury bond yields. The 10-year bond yield is down, so actually bonds have done better than everybody expected. Equities have done worse. The dollar has been not exactly strong, but has been okay. So if the dollar goes up, and that of course, if you have tapering in the United States, the trend in the dollar would probably be up. That of course, on the other hand, puts downward pressure on emerging market currencies. But we have seen a trend towards risk off, and of course with all the consequences. Also bear in mind that we have not seen a more than 10% correction in, let's say, in the US stock market since the fall of 2011. So we basically have been on an upward trend, almost in a straight line. And we're not terribly worried or scared if we have a little bit more on the downside in the near term. As I said, we are remaining overweight equities, and that's probably going to be for the 2014 period, maybe into 2015. Well, I think the RBA sees now inflation as the major threat, and they are, willing to do they're willing to bend over backwards to reduce inflation, because at the end of the day, if you bring inflation down, you bring growth rates up, and I think that's probably what the RBI is trying to do. At the same time, of course, they're trying to prevent the collapse in the currency, like we have seen in Turkey or Argentina. We don't think that's going to happen in India, by the way, because I think a lot of bad news is already discounted. But I think overall, the fight on inflation is on, and I think it's probably the right strategy for now, although it's painful in the near term, but it could be beneficial in the long term.